what is counted in GDP? So things that are counted. Value added by a used car dealer. Sure, that's going to be counted. Value of resale goods. No. All right, so if we just resell a good, we haven't created anything. All right, we haven't produced anything. We've just resold a good. So that's just transfer of ownership. That's not producing something new. Now, if a used car dealer adds value to the car somehow by, for example, being able to give a credible guarantee or providing more selection or convenience for the shopper, all right, all of those things are goods that are being produced. We can count that as a part of GDP. Sale of stocks or bonds? No. Commission paid to the stockbroker? Sure. All right, so this actual sale of a stock or a bond, that's not really, actually that's on the financial side of the economy. It's kind of weird, all right? It just doesn't exist if you really want to know the truth. All right, that's a transfer of ownership of a financial asset. All right, we haven't produced anything. However, the services provided by a broker is a service being provided. That is a good being produced. And so we would want to count that. Government transfer payments. A transfer payment is a payment that is just simply transferred from one individual or entity to another individual or entity. So if I were to just give you $100 and say, here you go, happy birthday, that would be a transfer payment. But did that represent any production? No, you didn't do anything for it. Transfer payments are, by definition, payments for things that, well, you don't do anything for. So there's no production happening. So work of a house spouse or children, or basically we can lump under here, under the table work that isn't a part of an official market, all right, or that isn't being paid for with normal currency, normal transaction. Those kinds of transactions, they don't show up. So the neighbor kid comes over to mow my lawn. I pay him $20 in cash. He never reports that in taxes because, well, he earns maybe, $500 for the summer, and it's below the threshold that you have to report. There's no reason why that would ever get counted. All right. Other things that don't get counted are black market transactions. So, like, for example, criminal activity. That's not going to get reported because, well, it's criminal, and well, criminals try to keep that activity secret because, well, it's illegal. There's other examples of stuff that just doesn't get counted. It's not too important that you know all the details now, but that gives you a kind of an introduction. Gross and net concept. So basically the difference between gross and net is depreciation. So within a given period, we always use up some of our capital. So remember, capital is the stuff we use to make other stuff. So let's say, for example, I'm a farmer and I have a tractor. I use that tractor for 1 year. Then that tractor has 1 year less life left in it. I've used it up some. I've worn some of it out. I've destroyed some of its value. We call that destruction of value or consumption of value of a capital asset depreciation. All right? Now, when I invest, when a business buys stuff, all right, a certain amount of that buying stuff is just to make up for the stuff that that has worn out. All right, so a certain amount of my capital investment is just buying stuff to replace other stuff that wore out. That's depreciate. That's investment that offsets depreciation. Then some of it is assets that are, or is investment that pays for new capital, right, to increase the capital stock. All right, well, net domestic product nets out depreciation, and so that we have net investment, and the only investment there is the investment being used to buy new capital stock or increase the capital stock. So net domestic product equals consumption plus investment plus government spending plus net exports minus depreciation. Net investment is gross investment minus depreciation. Good, we got that. National and domestic concepts. I'm not going to spend a lot of time on this because gross national product has really not been used in close to 25 years. So the difference is how we define an economy. All right, who is a member of the United States economy? Who's a member of the European economy? And how do we count what goes in there? Gross domestic product cares where the production happens. So if the production happens within the geopolitical borders of a nation, then it's in its economy. Gross national product cares who owns the productive capacity, the means of production. So in gross national product, if it's a citizen of the United States who owns the factory, then it goes into gross national product. So let's take, for example, a factory that is owned by Toyota, and let's assume that Toyota is wholly owned by Japanese citizens, all right, located in Kentucky. All right, that would go into gross domestic product because the production is happening in the United States. It would not go into gross national product because the factory was actually owned by a Japanese citizen. All right, and we can flip-flop that around and say, let's say an American owns a factory in Japan. That would go into United States gross national product because an American citizen owned it, but it would not go into gross domestic product because it wasn't located in the U.S. So gross domestic product depends on location. Gross national product cares about who owns it. And we basically use gross domestic product now and have for some time. All right. There is gross national product equals gross domestic product plus this net foreign factor income. Net factor foreign income is income from foreign domestic factor sources minus foreign factor income earned domestically. So it's just basically it's the difference between the two. I don't want to go into too much detail there because it is kind of an older concept. All right, we've talked about the expenditure approach to calculating GDP. Now we can talk about the income approach. So aggregate income is the total income earned by citizens and businesses in a year. All right, aggregate income consists of wages or employee compensation, rent, or that is the return for ownership of natural resources, interest, which is the return for owning capital, and profits, which is the return for entrepreneurship. All right, so aggregate income just equals the sum of those guys. Easy peasy. So if we look at this, first of all, notice aggregate income is the same as U.S. GDP. So what we saw before was that income equaled expenditure, and that actually has to be, that's an accounting identity. Because if you think about it, for every dollar of expenditure, so if I'm going to spend $1, somebody has to receive that dollar. And the person who receives that dollar that I just spent, that spending becomes their income. So for every dollar of expenditure, there must also be a dollar of income. So aggregate income equals this aggregate production. So this is an important identity. Notice that there's 3 bars here. It's kind of a weird looking equal sign. That means that's true by definition. So on one side, we have profits that hold this residual together. So aggregate income, that extra or under what it looks like production is, that's profit on the income side. On the production side, it's inventory. And those two basically accounting parts or accounts, or however you want to talk about it, are what keep aggregate income and aggregate production equal to one another. All right, so I don't want to go into this too much more. If you want to know more about these national income accounting identities, type intermediate macro. But this aggregate identity allows us to calculate GDP either by adding up the final value of output or by adding up the final values of all earnings and income. For further reading, I highly suggest you take a look at this article.